Here's a pretty simple tip that I've used to figure out where to put lines on a D1 chart to determine like risk reward, like, oh, where should I exit, or where should I think about taking profits, or how far can the stock reasonably run. So you can assess risk a lot better and you can size your trades appropriately so that you don't take like massive giant losses, or you take trades where you need so much downside of them to exit before the trade's invalid, but you don't really have a lot of room to run, which is not really a good idea. I try to take trades that have at least 1-to-1 room. So basically, that means that they'll move the same distance away from you or against you before you should exit, before your thesis is invalid, versus the amount of distance they have to move where you're right and you win. You want it at least 1-to-1. I mean, the higher your win rate, the higher you can take them, but I like 1-to-1s, and obviously anything more than 1-to-1 is nice as well. With this trade strategy, you don't need these like crazy 3-to-1, 2-to-1s, those types of things. They're nice, but you don't need them because the win rate on this type of strategy is just so high. And I like that because the psychology is really nice. I don't like losing almost all the time. I like winning almost all the time, and that makes me feel really good. So here's how you mark up these D1 charts to determine whether or not these types of trades are worth taking, even if they're weak, even if they have all the boxes checked off, okay? There's generally 3 different types of lines that you need to respect, and they're all support resistance lines. So these 3 different types of lines on a D1 chart are like trend lines, which essentially are algo lines if they're really sharp and solid with a high relative volume on them, SMAs, and then you've got horizontal resistance and support, okay? So just generally like levels, like, oh, let me delete this one. Levels like, oh, like this is kind of a level right across through here, or like here's a super high volume candle, here's a level right through there. So really you have these 3 types. You've got the diagonal lines, you've got moving averages, and you've got like horizontal levels. So how can you tell which ones are important and which ones kind of don't matter? Well, that depends on the strength of the stock at the moment. So how hard is it driving? How much relative weakness does it have? And more importantly, I believe, how much relative volume does this thing have? And the easiest way to do that is just to generally compare. So the reason why algo lines work so well is because they generally start at a really high relative volume candle. Like if you look in there, it's like, boop, above average volume candle, and they run all the way up. So this is kind of like a high relative volume line through there. And there's not going to be a lot of candles that can break it, but when they do have high relative volume, they can break it. And usually they need at least as much, if not more, to break that line as the volume it used when it started. With SMAs, what you want to do is decide first whether or not the SMA actually even matters on a chart. A lot of times charts are just kind of weaving in and around and through these SMAs, in which case they're not really significant. So when we look at this, like it's kind of there, like it's reasonable, like it tried to break it through there and came back out. But if you zoom out, it's been kind of cruising in and back and forth through these SMAs constantly. The only one it's really respecting right now is this 200 right here. So it's not that significant of a line on this D1 chart. On other D1 charts, it might be really significant, where let's say the trade's going down there, it bounces, and then breaks them. Well, that would mean more significance on the SMAs. But the big one I want to talk about here is horizontal lines, because these are awesome places intraday to either enter or to exit or to add, etc. So here's how you find them. You look at generally the relative volume of the position that you're currently in right now. And this one wasn't that much. It was like 1 or 0.8. And the reason why I took this trade was not because the relative volume actually kind of broke the rule here, but I took it because its positioning was just so awesome. It had so much upside and so little downside. But what you can do here is you can take a look at any D1 candle that's above average volume here. So this 50 moving average. And you can see where the opens, the highs, the lows of them are, and that will be a pretty good guide for you to figure out where to put your horizontal levels. Because this thing isn't just going to go all the way straight down until it hits the next pivot. Like that would be insane. That's a big moving stock. You need like 5 times relative volume for it to really push that far. But what you can do is you can use this 50 moving average thing. So relative volume right through here. This is really simple. All you do is you just take something that recolors the candles, to various stages of relative volume. So anything over like 1.5 is really white. Anything over 1 is like kind of grayish. You see there's like various gradients of the colors through here. And anything below is like barely visible. And then when you zoom out, you can like really tell where all the action is happening on this stock and where the important levels are. So if we zoom in through here, this thing ended up being higher relative volume, but we know right away that this wick right through here is probably something to be worried about. So I waited until we broke this position before I entered the trade, which was nice. And then I thought, okay, well, where's the next position? So I took a regular size position and it was sized for an exit above this 50 SMA. So it had a considerable amount of room to move. I wasn't really going tight and aggressive on it, but my plan was to add once it broke the next level. And the next level, you zoom out, look at this candle. So this is the next horizontal level right through here. Not super significant in the grand scheme of things, but if you remember, this thing didn't have a lot of relative volume. So it's going to get stopped by anything remotely significant, which is probably this super high relative volume D1 candle. So I had that as my next level, and that happened to be around like 2790-ish. And I added after it broke that level. As you can see, boom, it bounced around that level a little bit and then went back down. And you're going to see a lot of times that the intraday charts are strangely like respecting these random bounce points or these random jump points here. And oftentimes they are just respecting these high relative volume horizontal D1 candles. So use that, okay? So you got the three different types of resistances. You've got your diagonals, which is essentially algo lines, but they can just be like trend lines or whatever, or channels, etc. You've got your SMAs, and they only really matter if the D1 actually cares about them. And then you've got your horizontal lines. And then the degree of relative volume that these lines are following, the higher the relative volume, the more hardcore they are. The lower the relative volume, the less they really matter. And you'll find often that if your trade has enough relative volume in it, you can enter positions with a good probability of it breaking certain lines because it has more volume than the volume that the line was set on. For example, if this D1 candle was half the relative volume of my current position, I wouldn't give a damn about it. I would enter the full position right away with the high probability that it would probably just break through it. So that's it. Hopefully that helps you guys kind of figure out where to put your lines, what lines matter, what lines don't, and how to structure your trade so that you have good risk to reward ratio on these types of trades.